Good afternoon, possibly good morning, depending on where you're listening to us today. Welcome to another edition of a great webinar that we're hosting here at Advanta IRA. And we're going to talk specifically today about really self-directing for the passive investor. A lot of investments in Advanta IRA that our clients hold are passive in nature. So we're going to discuss and focus a little bit more on those and kind of compare and contrast them a little bit to those investments for people who want to be a little more active. And so as we talk about really active versus passive today, it's really we're talking about a mindset of an investor, of what types of investments you're looking at that are something that requires more of your time on an ongoing basis, or something really focusing more than on these investments that allow you to participate and then kind of take a back seat and sit back and enjoy the fruits of the different investments that you have. My name is Scott Maurer. I'm our Vice President of Sales here at Advanta IRA. Been with the company for a number of years. I have a legal background. I am a licensed attorney in the state of Florida. So if you have any legal questions, and we can't necessarily get into those to get questions answered for you from a legal perspective, but I definitely can maybe wade into some of those areas with you. I'm joined by my colleague today, Daharsh, who is one of our business development specialists and been with the company also for a number of years, doing a couple different jobs, and then finds himself now on the business development side of things. How you doing today, Corey?
Hey, Scott. Doing very well. Thank you for putting this webinar together with me. Just for the audience's perspective, as Scott mentioned, I've spent a number of years on the operations side of Advanta IRA, so having a roster of clients assigned to me, dealing with their day-to-day questions and helping them execute transactions. So as it relates to today's webinar, I've seen the passive investors and the active investors, and hopefully we're able to bring some light to what the differences are there. Just in general, you can have a passive investment strategy, but still be an active investor. And we're really going to try to break that down for you today. So hopefully we bring some great education, and looking forward to bringing you guys some good content. Thank you, Scott.
Yep, thanks, Corey. And yeah, if you're listening to this live today, there is a question box on the GoToWebinar panel. You can utilize that to ask either Corey or myself a question on something we're talking about, or maybe something a little ancillary to the subject today. So use that question box on the screen. We will monitor it throughout the presentation and get to those questions, but you have our contact information as well. Here on this slide, you can reach out to us afterwards, either by phone or by email to get your questions answered. Just a little bit about Advanta IRA. We are a self-directed IRA administrator, been in the industry almost 20 years. And the only thing we do at Advanta IRA is the administration of those particular accounts. And we currently administer over $2.5 billion in assets under management. We have close to 12,000 active accounts that we are the administrators for. We try to set ourselves apart really in two ways. One is with our customer service experience, delivering almost a concierge level of service to our clients, and getting them dedicated account managers for anything that they need regarding their account, the investments that they're participating in, and also on we also try to set ourselves apart with the education and the educational offerings that we provide to our clients. This webinar is one of two that we've done this week. We usually do one or two events per week. We bring in a variety of guest speakers and experts on different topics that are related to the arena of self-directed IRA accounts. So our agenda today, we're going to talk a little bit about the self-directed retirement in general, and the rules and the regulations, and then get in more into the active and passive strategies and considerations that are involved. Kind of what is, again, as we said, you can be an active investor and be participating in a lot of investments, but you're participating in passive investments versus, so we're really going to talk about what active and passive means, and definitely in the context of what we're talking about today. And we'll go through some case studies for the passive investing as well. Talking about syndications and private lending and unsecured lending, and we'll definitely take some questions from the audience today as well. Just a quick disclaimer: we do not endorse and provide any investment advice or endorse any particular products. So any information we're talking about today is really for educational purposes only. So consult with your attorneys, accountants from a legal or tax perspective. We can certainly refer you to professionals in those fields if you need some questions answered from that perspective. So just a little bit about self-directed IRAs and maybe why people haven't heard about them is really because most retirement accounts that individuals have are either IRAs or 401ks that are held with banks, investment brokers, and brokerage firms that offer you only those products that they sell. The IRS regulations, that Corey's going to talk about shortly, allow you to invest in a large variety of different investment products. You have to have a custodian, though, who is willing to hold those particular investments. So IRS regulations allow you to invest in real estate and private placements and making loans and precious metals and all these different things you can do, but you have to have a custodian who's willing to hold it. And the Schwabs and the Fidelities, the TD Ameritrades, those companies only hold mutual funds and stocks and really publicly traded assets. If you have a self-directed IRA, it really means you're enabling yourself to invest in a lot of different types of investments within the whole retirement spectrum. So at this point, I'm going to turn it over to Corey, who's going to talk more about the types of accounts that can be self-directed and a little bit on the rules as well.
Thank you very much, Scott. And one thing I want to add as I'm transitioning to talk about the account types is that sometimes you may have one of those managed custodians and the product you have with them, they call a self-direct product. But please don't be fooled. Sometimes those products may list as a self-directed product, but when you actually look into it, it's usually just a drop down of 20, maybe 30 or 40 publicly traded assets that you can invest into. A truly self-directed account and custodian is going to let you invest in anything you want to within the IRS rules, which is what we're experts in. And you can do that by any of these plan types. A lot of people are familiar with your traditional and Roth IRAs. Those are the standard accounts that most US citizens set up. They have an annual contribution limit that for 2024 next year is going up from $6,500 to $7,000 with a $1,000 catch-up limit if you're over age 50. But there's also other plans for small business owners. So if you are a small business owner with limited or no rank and file employees, the SEP and Simple IRAs may be a good fit for you, as well as the individual or solo 401k plan. And then the health savings and education savings accounts are other plan types that can be self-directed, that are specialized for those people with high deductible health policies or HDHP health accounts. And education savings accounts or covered L education accounts are a great resource for you to set aside money for educational purposes and tax shelter some money for those young ones in your life. And the account, if it's not used in full by that individual, can also be handed off or bestowed to next of kin at the time that person's no longer going to need to cover educational expenses. So great resources here. If you have any interest in any of these specific types of plans, feel free to reach out to Scott or I, or check out our website. We can definitely give you some more information and resource as to what plan is going to fit your needs best. Now, associating those needs with what your actual opportunities are is the next big step here in self-direction. And it's very simple to understand what rules apply and what individuals apply to how and what you can invest with and into. So as far as the IRS's rules, what they prohibit you to invest into, you cannot invest into a life insurance policy with an IRA account. There are some limited ability to invest into life insurance policies through 401ks, but that'd be something that you'd want to do a little bit more research on yourself. Again, reach us if you have questions. And the other restricted asset class are collectibles or anything the IRS would determine to have a subjective value. Examples are like antiques, artwork, fine wine. Some coins are allowed to be invested into. That is in itself precious metal investing. So not typically active circulating coins. We'll cover that a little bit more later on in today's presentation though. And the other side of what the IRS does to restrict your use of the self-directed accounts are labeling certain individuals as disqualified persons to you. So a disqualified person in general is your parents and your children or anyone up and down that lineal tree, your grandparents, your great-grandparents, your grandchildren, your great-grandchildren. Those are individuals that you cannot transact with in terms of buying or selling between or letting borrow or borrowing. You can partner with those individuals into a transaction. So you can definitely buy an asset together with disqualified persons, or there's other ways to kind of interact with them, so long as it's not basically sitting on the other side of a deal or a transaction. Shaking hands and doing a deal with that prohibited, with that disqualified person is contributing to a prohibited transaction. The other items listed here are UBIT and UDFI tax. We're not really going to jump into those too deeply today, but just for common understanding, Unrelated business income tax applies when your passive income generating investment through your self-direct account is bridging the gap or towing the line of being not so passive and a little bit more active. And then the UDFI, unrelated debt financed income, comes to play when you utilize your retirement account to actually borrow funds and take out leverage in the name of the retirement account. Those both apply in those scenarios. We've actually done a recent webinar, I want to say within the past few weeks, on those topics specifically. So if you have interest, check that out. We go over it in a full detailed webinar, either of those types of taxes that could apply. And again, just reiterating the disqualified persons rules, your parents, your children, one thing I didn't address on that last slide is yourself and your spouse are considered disqualified persons to your retirement account. So really just take a second to think you as an individual is a separate investing entity than your retirement account. Another aspect here is any businesses owned or controlled by these disqualified persons are also constituting prohibited transactions or disqualified person rules. So I cannot buy a piece of property from an entity that my father owns or that my father controls 50% or more stake in. So that in itself is an extension of the disqualified persons rules, any businesses owned by those individuals labeled here. So why are retirement funds a good source of capital? A lot of investors find that they have a very much quicker access to the funds to repeat investing. So once you do an investment with a group or make a specific deal that you like, it's very quick to reallocate those funds into the same investment, maybe with the same investment provider or a very similar investment. These accounts are retirement accounts. So if you're a younger investor and you don't plan to touch this money anytime soon anyway, it's a great resource to put it into a stable, longer term asset as opposed to the fluctuation of the stock market, kind of riding that roller coaster through the years. May not be your comfort zone. It may be your comfort zone to hold a more static asset for appreciation or long-term growth. They have better returns at that rate as well than most money market and CD accounts. You usually can find a self-directed investment that's going to earn for you or yield better over a long period of time than a money market or CD at a bank. And again, self-direction is the term here and is the industry in itself. No outside approval. You are your own financial advisor, fiduciary, tax advisor, or you're seeking those legal components and tax components and financial advisory components yourself. No one aside from you are making the decisions on how these accounts are being invested. And it's always up to you, as we said with the disclaimer Scott mentioned earlier, to do your own due diligence. So just a few examples of some alternative assets. We've got a ton of them. I mean, again, you just can't invest into collectibles or hard to value assets or life insurance policies. We see a lot of real estate investors. So a lot of the bullet points you'll see here are real estate based, rental homes, commercial properties, fix and flip properties, tax deed and lien investing, even issuing paper assets for other real estate investors potentially. So issuing mortgage loans, issuing hard money loans to maybe friends or business partners or people in your community that are looking for a better rate than the bank will give them, and you're looking for a stable investment, maybe to support someone in your circle that needs that money to get a business off the ground or whatever they're doing. But you can also invest in some more unique assets that you would have not thought otherwise, like funding a movie project, investing into farmland or farm animals or timberland. We've seen clients do a number of different things based on what their area of expertise is and maybe what they've developed, an ability to earn in a specific sector, to really realize that you can keep earning in that sector, in that lane of investing with your retirement account is in itself a door opener and an eye opener to a lot of people when they start to hear about self-directed being an even possibility for them. And with that, I believe I'm turning it back over to Scott at this slide. Scott, I see you've got the mouse wiggling.
Yes, sir. So yeah, before we get into a great question came up on the prohibited transaction rules we'll address. Someone asked, if my friend and I are forming an LLC, basically do a 50-50 partnership to invest into maybe a bigger venture, can I fund my 50% share, can I fund part of my 50% share with both IRA and personal funds, while my friend funds his 50%? Or would this be considered prohibited because both my retirement fund an IRA involved. And so the answer to your question is yes, you can fund your 50% both with IRA and personal funds, but what that would create then is that your LLC that you're forming isn't a 50-50 partnership. It's maybe a 50-25-25 where your friend owns their 50%, you own 25%, for example, and then your IRA owns the other 25% in the LLC. So it's just important to know when you're thinking, especially about the prohibited transaction rules, that your IRA is its own separate entity from yourself. So it would need to be listed separately within that LLC operating agreement. So yeah, it is possible to do what you're talking about. You just can no longer maybe change the percentages between yourself and your IRA within that LLC, but you could partner up your IRA funds and your personal funds to make up that 50%. So just wanted to get that question answered. So we'll kind of jump now in again more to the meat of our presentation, talking again about the active versus passive investment strategies. All IRA investments are really intended to generate passive income. So whether you're getting rents from a rental property, or you're getting the dividends, or the interest from a loan or something like that, it's all passive income back to your IRA. But really, talking about active versus passive, we're really referring more to the time, what's involved for the actual investment itself. So when we kind of look at what an active type strategy is, we're talking about maybe rental property where you are, whether it's a short or long-term rental, you're going out and finding the real estate, finding your tenants, working with your tenants. If it's a piece of real estate that needs some work as well, you're working maybe with the contractors involved to get the repairs done on the property before you rehab it or rent it. There's the checkbook control LLC that we, again, do a lot of different webinars on that topic as well, where you are making investments in and out of an LLC, like the question that just posed to us, where you have an LLC as an entity. You're conducting the investments, you're keeping track of all your LLC documents, etc. And then there's a ROBS plan where you're allowed to maybe start your own business with retirement plans. So all of these investments, when you look at it from a strategy perspective, are kind of ongoing, right? If you're owning a rental property, your duties as a landlord almost don't stop. As long as you're renting the property, you're going to have to deal with your tenants and any maintenance and things like that. As opposed to more passive strategies, maybe a syndication where you're investing your IRA funds into a multifamily real estate project where someone else is handling the day-to-day duties. The general partner deals with the tenants of a multifamily project and deals with the expenses. You can basically contribute your funds up front. You do your due diligence to evaluate that up front, and then from there, the general partner takes on that activities. Same thing, it's very similar to doing partnerships or investing in private stock. Again, you do your due diligence up front, comfortable with the investment, you make the investment, you sit back and receive your dividends at a later date. There's private lending, where you're lending money from your IRA to a borrower. Again, you're making all your efforts are up front in the process, and then sitting back and waiting for the loans to come, the loan payments to come back to your IRA. And certainly the precious metals type investments where you're buying gold, silver, approved coins, which we'll talk about a little bit later. They're basically holding them for long term, as a hedge against inflation, or maybe you're getting some long-term appreciation. It's not something that you're day trading with those. So it's kind of, again, the strategies when we're talking active or passive isn't necessarily the type of income per se, because all of the income that coming back to an IRA is passive income for the most part, where there are no tax ramifications because that's passive income to your IRA account. But it's more about what the strategy is. And really the pros and cons, of being an active versus a passive investor. Active investors, yeah, you're in more control. If it's your rental property, you're controlling the asset, you're deciding on your tenants, what needs to be done. You're much more hands-on, so you get that control aspect of it. But that is certainly going to eat up more of your time and energy and other expenses as well. If the responsibility for details, if the tenant, something happens with your rental property in the middle of the night, that tenant is probably calling you to help get that problem and issue fixed. Again, contrasting with passive investors, there is not as much time commitment. You do the investment up front, you sit back and you get mailbox money. A check arrives every month. or an ACH or wire arrives every month to your account, and you're not going to be bothered by those little details. Especially if an apartment complex is being renovated, you're not picking out the fixtures or deciding on the colors of the doors and things like that. You're entrusting the general partner to handle that type of an investment. Downside of being a passive investor is if you're someone who likes to be in control, likes to make those decisions, you do have to kind of check that and allow someone else to make those decisions going forward. And you're not going to have a lot of say in the decisions. If you're investing in the private stock of a company, you're a shareholder, and maybe you do have some voting authority here and there, but on day-to-day issues and day-to-day offerings, that's going to be left to the managers and the presidents of those particular investments. So, which strategy is best? I mean, I really think for an individual, this takes some introspection to really consider, where is my expertise? What are my interests? Do I want to be involved on a day-to-day basis? Do I want to have that control, even though that might take up a lot more of my time? Or do I want to sit back? Do I have other things, other interests that I would like to pursue? Regardless, if you have funds, and especially from our perspective, in an IRA account, they need to be invested in some type of investment. And obviously, the things that we promote are diversification within self-directed assets. There's going to be some work done up front, and certainly taking an eye and keeping an eye on what's going on in your retirement account, but really finding them the balance of setting those investments in motion and then allowing you to pursue other activities. We do encourage a lot of networking. We do a networking event once a month online. There are certainly networking events in your area, wherever you may be located. If you want to learn more about the different strategies and talk to different people, you're going to be able to find individuals who've been there and done that already. And a lot of people at these events are very willing to share their experiences and help you figure out your strategy as well. So at this point, I'll kick it back over to Corey. We'll jump into our case studies. Looks like maybe we had a couple of questions pop in. So maybe, Corey, we could tackle some of those first. Does that make sense?
Yeah, Scott, I was actually going to make the same suggestion. I see a few new questions popped up in the questions box, and it's a perfect pivot before we jump into the case studies, probably, to address these.
Sure.
Do you want to go ahead and read off the first one, and then I'll read the next one after that? Yeah,
the first one, we will, I'll follow the question someone asked a minute ago about the 50-50 partnership in the LLC. There was a follow-up to that. That said, we've already formed the LLC with only 2 limited partners. Do I need to update the LLC registration and the operating agreement documents to reflect the new ownerships? Yes, that would be your step. So there are 2 phases of setting up an LLC. One is registering an LLC with the state, where you name who your managers are of the LLC. But the operating agreement is really where you control where the investments and who the members of that LLC are. And if you have not yet, contributed anything to this LLC, you're just getting it started, you can certainly amend that operating agreement and update it to reflect the different owners. And Corey, do you want to take one of the other questions?
Yeah, I'll take the other ones listed there now. The next one listed there is, can I move money from my SD IRA to a qualified rollover IRA? Just to confirm on the transfer and rollover protocols here, if you have an SD IRA and you want to move funds to any other IRA, maybe it's a managed account elsewhere, there's no restriction to doing that. That is considered a custodian to custodian transfer. You can do that as frequently as you would like for whatever dollar amounts you would like. There may be some transfer fees associated, like a wire fee or something like that, but it's always something you can move between like accounts, so IRA to IRA, whenever you want. You just initiate that with a transfer form with the company you'd like to receive the money, and usually that's facilitated within roughly a week or so between those 2 companies connecting with each other and moving your money. So always a possibility for you to do that. A rollover IRA in itself is just an IRA that has been funded with a previous employer-sponsored plan, like a 401k or a 403b or a 457 or a thrift savings plan. So just to kind of answer that question, even though I know it wasn't explicitly asked, if you're trying to move funds from one of those type of plans, maybe a job you've left, so a previous employer plan, or a job that you still have, but you're eligible to do what's called an in-service rollover, You initiate that by doing a distribution request with the current plan administrator and a rollover certification with the company you'd like to receive those funds. As long as that's a direct rollover, meaning it goes straight from one account straight to the other account, you can also do that as frequently as you would like. But if you're going to do what's called an indirect rollover, meaning you want to take that money for a little bit of time and then put it into a qualified plan, you have 60 days of holding that money before you have to put it into a new qualifying plan, and you're only able to do that once every rolling calendar year. So if you did it tomorrow, you would have to wait 365 days before you're allowed to do another indirect rollover. And that is between accounts that are of the same tax status usually, so traditional to traditional. But with a rollover, you can also do a Roth conversion where you're kind of giving up the tax write-off on the traditional side to convert it to Roth, pay the taxes on that money, and let it grow, invest completely tax-free moving forward. So may have been a little bit of a thorough answer there, a little bit of off the rails from the actual presentation, but I think it's important to make sure we outline that information to the audience as well. One other question here before we get back on track with the case studies. How do you choose what companies you invest with? And then a clarification, not invest with, but work with. So Advanta IRA, we don't necessarily make that choice at all. We are happy to work with any investment provider or any clients that find us, hear about us, are interested in working with us for the general purpose of benefiting these clients that have self-directed funds and want to make alternative investments. So I don't think in my time with the company, maybe Scott can elaborate further, that we've ever turned down a potential partner just for the purpose of coordinating investments. And again, as we mentioned earlier, I know Scott mentioned it on the disclaimer, I mentioned it once or twice as well. You're, as a client, as a self-direct account holder, doing all the due diligence. So it should be on you to make sure you vetted the product and vetted the investment company and everyone that you're planning to work with before you actually fund that transaction. We're not here to say, oh, that person or that group is shady, or oh, that person, that group is great. That is completely up to you. We're here to facilitate the transaction by following the IRS's rules and regulations to the best of our knowledge, which we're experts in. But it's ultimately up to the client and that investment provider. Sometimes investment providers tend to work with us because of our customer service and because of the educational content we put out, and we build a strong network. And as Scott mentioned earlier, it's always important to build a strong network in whatever seat you're sitting in the investment world. So know, like, trust is something that you should always fall back on. Scott, anything to add to that effect?
Yeah, just very quickly, as far as choosing companies to work with, as Corey mentioned, our role is not to do the due diligence on the investment. Our role is going to be to make sure that the investment paperwork, as you'll see as we go through this first case study, the paperwork is completed properly. So if you bring us an investment that you'd like to make, as Corey mentioned, we've never turned down an investment, from a due diligence perspective, because that's not something we do, but we have turned down certain investments if we can't properly document the actual investment. So hopefully that helps clarify the answer. But Corey, I'll let you get going on our first case study.
Yeah, that's actually a good softball pitch into this case study. So we're talking here in the first case study on investing into a syndication, or basically a limited partnership investment, a larger group that's putting a deal together where you're just going to put some money in because you've prospected the deal and had interest in it and really don't have any responsibilities besides putting up some money and waiting for the money to come back to you. So in this case, I've got Larry and Malcolm. Larry's got a retirement account with a managed custodian, and he meets Malcolm, who's a syndicator or a deal offerer. They speak, they meet, they go over the full prospectus of the investment. So usually there's a private placement memorandum, an operating agreement, a subscription agreement, and a few other documents that Malcolm is going to provide to Larry, let them look it over at their convenience, do their due diligence with the legal professionals and tax professionals in Larry's life. And in this case, he decides he does want to move forward, and the minimum investment's $50,000. That's what he's going to settle at. In these deal structures, that's a pretty standard amount. Sometimes you'll find them lower, but on average, $50,000 is a pretty comfortable and reasonable expectation for this type of investing. So to move forward, Larry sets up a self-direct account with Advanta, completes a transfer form, which I just referenced in answering that question, to get the money moved out of that previous custodian over to Advanta. And then we facilitate both opening the self-direct account, getting that transfer request over to the previous custodian, and we'll also start rolling the ball with getting the investment paperwork approved by the account holder, Larry, in this case. So the account manager on Advanta's team, a role I served a number of years as, is going to coordinate and facilitate this. Basically, we typically collect the investment paperwork directly from Malcolm. We set that up through DocuSign after a review to make sure it's all in IRS compliance, so that we're just collecting Larry's approval of the paperwork and making sure that it's being approved and executed in the name of Larry's retirement account, not Larry as an individual. So an example of that is Advanta IRA for the benefit of Larry Fisher and then his IRA account number. The tax ID number used on all this investment paperwork needs to be the trust tax ID for Advanta, not Larry's social security number, so there's no tax consequence or any potential conflict in the future. And once Larry's approved all that paperwork, an authorized signatory from Advanta will actually be executing it on behalf of the transaction, and then Advanta, the account manager, will send out the wire over to Malcolm's team. So as a, again, rounded example, but still reasonable figures here for this type of investment, Malcolm's partnership pays an 8% preferred distribution to all subscribers on a $50,000 deal that boils down to $4,000 a year. In the 5th year, the project's refinance, which is common with syndication real estate, and the lump sum payout that Larry receives is $65,000. So in total, for putting up $50,000 and basically sitting on that value for 5 years, Larry's IRA generated $20,000 in total in yearly preferred distributions and another $15,000 profit at the end. So that's $35,000 of either tax deferred or completely tax-free income that's been generated from this style of investing. Again, these are rounded numbers. I don't want you to have the expectation that this is, a $50,000 investment over 5 years yields $35,000 every single time, but it is definitely a possible opportunity and outcome. With that being said, I think I'm going to turn it back over here to Scott for the next case study, and then I'll jump on one right after that.
Yep. Thanks, Corey. So the next kind of a passive investment strategy we'll talk about is really kind of an equity partnership or a joint venture arrangement utilizing a note, where the IRA account is a passive investor in a particular deal. In this case, the facts are that Andrea has money in her IRA account, and she meets Steve at a local investor group. Steve is a rehabber. He's got a property, he's got a project. He needs funding for this particular investment to get the property turned around, flipped, obviously, and walk out with his profit. Again, as always, it's important that Andrea does her due diligence on Steve and the property he's looking to flip. So Steve says, I can use the property that I own personally now as collateral, and I'll use some of my own funds for a down payment. But I need to borrow, obviously, the rest of the funds not only to purchase the property, but then also have enough cash to do the rehab as well. So he's going to have to actually acquire the property and have the cash there to do the rehab. Again, Andrea does her due diligence. She's satisfied with the project. Again, the work she's doing is up front. Andrea's not going to be the one deciding what to rehab in the house, what to paint the walls, what types of appliances to put in, etc. She's just deciding up front, is this a worthwhile project for me? Is this a good investment for my IRA account? And again, they structured this investment using a loan and a note, where the loan amount, she agrees to lend him $125,000 at a 5% interest rate. But what's the kicker here is that she's going to get 1/3 of any profits that Steve makes on the property. So it's going to be up to them to make sure to make sure, obviously, that the profit, how they define the profit, is in the note and between the two of them. But again, this loan is going to be secured by a first mortgage on the property. Andrea has her attorney prepare the note and mortgage documents to outline the terms that her and Steve have agreed on. And again, within that note document, the lender, Steve, is going to sign a note, and he's going to sign a mortgage to Advanta IRA for benefit of, Andrea's IRA account. Again, that's the important aspect for us to make sure everything is properly titled. And then, 6 months goes by. Again, Andrea has done really nothing up. She put the money up front. She sat back while Steve has rehabbed the property. When he's ready to pay off the loan, he's going to get back in touch with Andrea to figure out how much exactly he needs to pay her IRA back in order to satisfy the note and the loan that was encumbering the property. In this case, she'll get her repaid principal. She gets those payments back each month for that 6-month period, and then she's going to get 1/3 of his profits, which in this particular example was 25,000. So Steve made $75,000 on the flip. But in order to use Andrea's money, he gave her part of the profits in order to secure that kind of joint partnership arrangement. And even after paying back Andrea's loan, Steve still walks away with the $47,000 earnings back into his pocket, while the funds went to Andrea's IRA account. Now, I'll turn things back over to Corey as we go to the next case study. It looks like we had a couple of questions come in. Someone asked, are there rules against a deal with a family member? And the answer is yes. That's the thing slides Corey went over a little bit earlier, that if you're looking to use your IRA, using, say, this last example that we did with Andrea and Steve, if Steve was Andrea's father or child, and Andrea was Steve's mother, there are rules that would prohibit her from making that investment with Steve because he would be considered a disqualified person. In the first example with the multifamily deal, if the syndicator, the general partner, is a disqualified person for your IRA, the person acting as general partner is your father, your son, your spouse, or yourself, even for that matter, it would be considered prohibited. So there are certainly rules with dealing with those particular family members. Now, again, brothers and sisters, aunts and uncles, cousins are not considered disqualified persons. So just something else to consider. But if you're looking to do an investment with a family member, that's something we got to define which family member it is, and then kind of evaluate it from the prohibited transactions rules. So Corey, I'll turn it over to you at this time.
Yep, perfect. Thank you, Scott. Yeah, and just to add on to that, that is what our expertise is. So if you're someone that has a potential deal with a family member, just speak to, if you're an existing client of ours, your client account manager to talk through the logistics there. Or if you're not a client yet, you could reach out to Scott or I offline, and we'll be happy to kind of break that down and help you adjust your strategy to fall within the IRS rules and make the investment of your choice. So jumping into this final case study for today, this is going to be an unsecured lending case study, similar to what Scott just covered with the secured note between the real estate investor and the retirement account holder. But in this case, we're going to do an unsecured version. So no collateral, no actual recorded instrument in case the borrower, for lack of a better term, runs off with the money per se. So we've got Lisa, who has an IRA, and she's got a friend who's looking to expand his business and needs some short-term capital. So with something like that, he doesn't want to go to a bank because they're going to charge a higher rate, and he has a good friend, Lisa, that's got the money sitting ready to use. Lisa decides to lend the money out of her IRA and is willing to lend without any collateral. Again, maybe they've had a long-term relationship, they're friends from high school, from college, or they just know each other as distant relatives that are not disqualified. Whatever the case may be, Lisa is comfortable enough with this borrower to not utilize a collateral instrument. So it's between her as the account holder and the borrower to come up with all the terms. No one like Advanta or any other governing body is here to decide or determine what terms you have to use for this type of loan. And you can really draft that up on your own piece of paper or go online for like a LegalZoom type promissory note template. In this case, very simple, $50,000 loan at a 10% interest rate, 1-year balloon. Ideally, a lump sum payment of $55,000 comes back if everything goes to plan. So the process, very similar to the process we went over earlier. Lisa's account manager receives the original note. It's important to identify, in this case, with it being an unsecured investment, the original wet sign note from the borrower with that borrower's ink signature has to be in our office before we will release any funds. That is the only instrument of any use if that borrower starts to delay on payments or default on the loan at all. So it's very important that that be coordinated. If there's a tight timeline for this transaction, it's very important that that borrower signs that piece of paper and mails it to our office or even overnights it to our office if possible. The lender's name, again, is Advanta IRA for the benefit of Lisa Smith with her account number, and all payments flow directly back into Advanta IRA. There's no context or capacity where Lisa should be receiving and or depositing the payments directly. Now, if she wants to serve as a de facto loan servicer to make sure the payments are made in time and she can assess any late fees or penalties at her own discretion, she can have these payments sent to her, like mailed to her, and then forward them along to Advanta upon receipt. but it still needs to be made payable to the retirement account, not to Lisa personally. Alternatively, we can also generate ACH instructions. So this can be handled ideally digitally directly from the borrower's bank account straight to Advanta IRA's back office accounting department. Some special considerations, again, unsecured loan, no title company is involved. We must have that original note before we release any of Lisa's funds. That's a security instrument in ourselves to protect Lisa and her retirement dollars. And since this unsecured lending is more risky than your conventional lending, you're going to tend to see, if you're a borrower or if you're a prospective lender, higher interest rates, maybe a little bit more due diligence being done on the actual deal or on the actual borrower. So make sure, if you're someone that's negotiating an unsecured transaction, that you make those considerations and really be thorough about how and what you're willing to risk, because it is risk in any event that you're making an investment, as to what could happen if it doesn't pan out the way everyone wants it to and or expects it to.
Yep. So next kind of thing we'll discuss, not a case study we're going to talk about, but did want to discuss kind of precious metals investments. Again, something else that I think fits within the passive strategy of investing, where you're buying metals up front, you're determining when to buy, how much to buy, et cetera. And then your when you're precious metals investors are to then sit and hold it for a longer period of time. There are a couple different types of precious metals investments. If you're looking to invest in gold and silver, in different ways you could do it. One is certainly by, as we'll talk a bit more about, buying coins, certain coins that are minted by government agencies. You can buy bullion and bars, the actual physical bars and coins are one option. You could also invest in exchange traded fund, ETFs that you could probably do through your brokerage account that are tied to the value of gold or silver or other precious metals. And there's certainly paper gold and gold certificates, where companies don't sell you the actual gold that they have, but they give you a certificate kind of what amount of gold you're buying. So all of these have different considerations for different people as what's you're more comfortable in doing. There are people who certainly want to invest more so in the actual coins and the actual bars that they can see and know that they have in the to have on hand inside their IRA account. That's what we see a lot at Advanta with self-directed accounts, are people wanting to buy the actual coins, the actual bullion and bars. If you're wanting to buy an ETF or a company where you're getting more of a gold certificate, that's you can typically do many times through your regular brokerage firms. So we're talking about precious metals in an IRA and buying the actual physical metals. It's important that the metals that you purchase meet certain IRS-defined fineness requirements. Typically, the gold or silver needs to be at least 99.5% pure. Just because a coin was minted by a government, though, does not automatically make it qualified for an IRA. So you would want to work with a dealer, precious metals dealer, who understands exactly which coins are specifically approved under IRS guidelines. I can tell you that the American Eagles, the US minted coins, as well as the Canadian coins, the Maple Leafs, are qualified to be held inside of an IRA account, as well as certain bullion bars that are stamped as well. One important note, although you're buying these metals, buying these physical coins, buying these physical bars, you as the IRA owner, getting back to some of the prohibited transaction rules we talked about, you as a disqualified person cannot have physical possession of the precious metals owned inside your IRA account. So you would have to use a third-party depository. Advanta currently works with 8 different depositories across the nation and even one overseas, where you buy the metals from a dealer and then we create an account for you where those metals get shipped to an account at one of those approved depositories. Again, so you cannot physically, personally have possession of that metals. There was even a court case that came down a couple of years ago where some individuals were trying to use an LLC as kind of an end around that rule, basically creating a single member LLC for their IRA to own. The LLC bought the metals, and then as the LLC manager, the IRA owner personally held those metals in a safe at home, and they lost that court case. So again, you need to have a third-party depository actually holding on to these particular metals. So again, buying metals, though, do your due diligence to be satisfied with what you are paying for those metals. There are, you want to work with a dealer who understands the different fineness requirements and what the IRS expects and what their criteria is for investing in precious metals. But also do your due diligence, shop around, see what prices that different dealers have. They all have different markups for their services. So it's, again, up to you to do that due diligence up front. Again, the metals that are typically allowed are gold, silver, that we see for the most often. You are allowed to buy platinum and palladium as well. There are 1 ounce, half ounce, quarter ounce, and 1/10 ounce gold coins, and the 1 ounce silver coins minted by the Treasury are allowed. Again, as I mentioned, also some other countries. Currently, Australia, Canada, and Great Britain, you can buy that government's issue of particular coins. And again, there's certain bullion bars and rounds that meet those fineness requirements as well. Unacceptable products, if it's a gold or so, it may be a gold or silver coin, but maybe its value is different due to some certain aspect of the coin. I've heard of coins signed by certain individuals or printed a certain way. If their price of that coin is different than another, say, 1 ounce regular US gold coin, then you're probably getting into the arena where you're buying a collectible, where you would want to make sure, absolutely certain, that the person you're buying from is certified that this is an IRA approved investment. Otherwise, you could be buying a collectible gold coin. Certainly rare coins, from way back in history, those are going to be prohibited as a collectible under the rules. Something called a Dory bar as well, where it's gold kind of in an unrefined form. Again, it's not meeting the fineness requirements the IRS has laid out for metals. And again, lastly, you can choose from the different depositories. If you find your own dealer and a depository that they have, we're certainly open to doing business with those as well. So as I switch it back over to Corey to finish out today's presentation. Certainly any questions you have, there's a couple that come in, we can get to those here at the end. If you have any other questions for people that are listening, make sure you get those typed in. We'll make sure we hit all those before we end the presentation today.
Yeah, guys, I'm going to just go over the key takeaway points, show you a little bit more information about what we offer from an educational perspective, and then we will finish the final few questions added in. So please take your time right now to go ahead and add any final questions, and Scott and I will answer those within the next few moments. One thing as a key takeaway I want everyone to make sure you understand is that all self-directed investments in itself are generating passive income, but only some strategies, as we've covered today, are considered passive. You could have a passive income generating asset, but still have an active role in it, like some of the investment opportunities that we talked about today, but didn't necessarily cover because we are focusing on passive strategies. Conducting your own due diligence very, very thoroughly and knowing what your responsibilities are for the investment you choose to make. So you don't end up walking into a deal where you think you're going to be completely passive, like a real estate flip or something like that, where you actually have some responsibility, like coordinating the contractors and various different roles that may be in place. Make sure you fully understand that and have a grasp of what in a year or 2 years down the line on a maybe 5-year investment path that you have is going to entail regarding your time and energy and efforts. And again, keep it passive. No sweat equity or current benefit from yourself or disqualified persons can go towards the investment or your retirement account. So for real estate and the disqualified persons, you can't, let's say, change a light bulb or change the floor or paint in a house that you own, nor can your disqualified persons if it's owned by your retirement account. You've got to do trusted non-disqualified friends or non-disqualified relatives, your local handyman. We're not saying you have to use a licensed and insured individual, but we are saying you cannot use disqualified persons or yourself for those different responsibilities. Again, because it has to be passive and you cannot contribute yourself now to your retirement account. The term the IRS, I believe, tends to use is current benefit of future self or future benefit to your current self. Again, our Knowledge Center, I know Scott covered this early, we try to put out a lot of complementary education. I believe we probably lead the country in the industry of free educational content by a retirement account administrator in the self-directed space. We do educational webinars twice a week. We have a podcast hosted by our colleague Alex Perney, the Alternative Investing Advantage podcast. And our video library of all these podcasts and webinars is on our YouTube channel. So at youtube.com, Advanta IRA, you'll find this webinar if you're watching it. Maybe you found it there, and you'll find tons of other webinars with great expert speakers and guests that we bring on to bring the best education to you in the industry. And if you're in our local areas, we've got an office in Atlanta, we've got an office in the Tampa, Florida region, and I live and work remotely in Western North Carolina. You may see us at networking events. We may be putting on our own networking events, hosting them, or you may just mingle with us. Please feel free to, shake our hands, ask any questions you have if you see us out and about, or be on the lookout for when an event may be going on and come participate with us. We'd love to have you. And if you have any other specific industry standard news or information you'd like to follow, we have a blog for that. I know with the election cycle coming up soon, there may be some pressing information based on legislation going through that has anything to do with the retirement account industry. Last time the election cycle went through, we started a change.org petition for some things that we really wanted to get removed out of some potential laws. And I believe we were successful in that, the items that were attacking some of the rights that a retirement account holder has for self-directed investing were planned to be taken out. So we had a chance to start the petition and get that removed from that legislation. And Scott mentioned one other time that we do a networking event ourselves called Pitch, Promote, and Prosper. This is typically once a month, usually the last Friday of the month as of late, but with this month being a holiday, we're doing it next Friday, which is the 10th, if I'm not mistaken. Correct. Friday, November 10th, 12 p.m. to 1:30 or so Eastern time. Everyone that signs on to this call gets a chance to say who they are, what they're looking for, or what they have to offer, and really network from there. Because we're a self-direct administrator, we cannot endorse or promote any specific product or investment or anything. This is the closest or biggest opportunity we have to let you as an investor or as an investment provider get in front of our audience and really just network with each other, ideally bringing like-minded individuals together to, to build a better network for your net worth. Having said that, I'm going to go ahead, and just say you can open an account with us in about 15 minutes. It's a real simple application. I went over in answering a person's question earlier, how easy it is to fund these accounts. And you could typically get your account set up, funded, and ready to make your first investment, conservatively speaking, within about 10 to 14 days. So it's a relatively quick turnaround time. Reach out to Scott or I if you have any questions or would like to get started. I'm going to go ahead and flip it over to our presenters slide, so you have all of our contact information, and we will jump back into these final few questions that came in. I'm seeing one here. Is my wife's son disqualified for me to lend to, as we are not related? That is a great question. That is a kind of a caveat and a gray area related to that disqualified person's rules. I'll let Scott correct me if I'm wrong here, but my interpretation, even from my days as an account manager, was that if this son is a grown adult and you've never financially supported them in your life, you maybe married that mother later on after that son was no longer dependent on the mother, then this would not be disqualified. But if there's any capacity that the son ever lived under your roof and you had some sort of financial or reliance from the son on you, then you should seek legal guidance as to determine if this loan would be allowed or not.
Yeah, that's correct, Corey. Yeah, your wife's son technically not disqualified under the rules, but if there's a way that you or your wife would benefit from the transaction, your IRA, by lending money to him, then there's ways that could still be prohibited because either you or your wife is getting a benefit. But on its face, if you have not adopted that child, then it's not prohibited, at least initially, on paper, for your IRA to lend to him. Another great question came in. If your IRA lends money to someone who runs off with the funds, and you need to file suit, does the IRA file suit since it's separate and apart from me? The answer is yes. Your IRA would be the plaintiff going after the borrower as the defendant, and you would work through Advanta to get that lawsuit filed, have any legal fees get paid by the IRA, and ultimately, hopefully, any recovery then would come back into the IRA. You certainly, though, would be involved in choosing your attorney and choosing kind of what courses of action you wish to take. Someone asked about the fee structure for us to set up a self-directed IRA. Is it online? Absolutely. Our fee schedule is online, as well as the paperwork to get started. Very quickly, just a quick outline. Our fees, we charge a $50 fee to open up an account. There's a $95 transaction fee. The case studies that we went through today, to do the paperwork, make sure things are properly titled, get your approval on it, that's a $95 transaction fee. And for most individuals, we charge $295 a year for each asset that we hold at Advanta, and that fee then includes us receiving income back into your account, doing all the IRS reporting, and acting as a custodian for your IRA. If you're looking to do multiple assets, there's a different fee option we may have that would be more advantageous than a flat $295 a year. But that certainly is online, or you can contact Corey and I, and we can certainly get you that information over to you. Corey, looks like we did have one other question before we wrap up, and somebody asking about setting up a Roth IRA, or they've done a Roth IRA with a backdoor Roth contributions. It's a little bit more of a complicated issue, so I would encourage that individual to reach out to Corey or myself to get those questions answered, and basically the question centered around whether the proper reporting was done, and that's a difficult one to get into for kind of this format. But we certainly can reach out to you afterwards as well to go over that issue. But Corey, any parting thoughts here before we wrap up?
Yeah, Scott, I just wanted to expand really quickly on our fee structure and how we handle things to that effect. Part of my job as a business development specialist, and even when I was on the account management team, was to make sure the clients understood the fees and are happy with them. So we're very black and white with our fee agreement. We have it listed online, as Scott mentioned. It's the 4th page of our 6 to 7 page account application. And really want to make sure everyone's comfortable with the fees, so no one comes back later and says, "Oh, Advanta has this, hidden fee or behind curtains." Like, it's all black and white. It's right there on the document. Anything we would ever charge any client is listed there. So we always implore you to have that conversation. If there's any questions you have, let Scott or I know, and we can very thoroughly break down what that item is, why we would assess it, and even learn a little bit more about your scenario to know if it's even applicable for you in any scenario or not. So, we're trying to be as honest and forthcoming about what we charge and why we charge it, so that our clients, it's already a thing that self-directed investing is scary, or people are apprehensive to do it because they don't know too much about it. The first thing we want to do is make you as comfortable and confident as possible, and where we can. Where we cannot is exactly what you invest into, and again, that's part of your due diligence. So our goal is to make everything else centered around this investing easy for you. That would be my kind of final part, and I hope everyone had a great time here today and learned some good information about passive investing strategies, and look forward to seeing you on the next educational content, or having you reach out and having a chat with us.
Yep, Corey, good time as well. And yeah, anyone, any questions you have, again, related to the topic we talked about today, something ancillary, like I said, specifically the one question on the backdoor Roth IRAs, just contact Corey or I individually, and we're happy to walk you through it. So at this point, I'd be happy to we'll end the webinar, and appreciate everybody listening in and logging in today.